The rate that you receive for your mortgage is determined by several individual factors such as loan to value, property type, credit rating, loan amount, and type. This is why there isn't a one-size-fits-all rate for everyone. However, in general terms, everyone is subject to the same factors that impact rates from a market perspective. That is what we are going to look at today. Mortgage interest rates are determined by the pricing of mortgage-backed securities or mortgage bonds. The media often implies mortgage rates are based off the 10-year Treasury note. This is incorrect. While the 10-year Treasury note has been known to trend in the same direction as mortgage bonds, it is not unusual to see them move in opposite directions. Mortgage rates may change throughout the day. However, they only change on days when the bond markets are trading securities, since mortgage rates are based on mortgage bond prices. Think of a mortgage bond's sales price similar to that of a stock that trades up and down during the course of a day. Mortgage bonds are largely affected by various market forces that influence the changing demand for bonds within the market. Some of the key economic factors that have the greatest impact are unemployment percentages, inflationary fears, economic strength, and the overall movement of money in and out of the markets. Like stocks, most fluctuation is caused by consumer and investor emotions. The Federal Reserve and its monetary policy have a huge impact on mortgage rates, as their overall plan for our country's economic growth dictates the flow of money, which affects pricing on both short-term and longer-term loans. Adjustable rate mortgages offer lower rates due to the shorter term of the fixed rate. When your time frame for paying a loan is shorter, as an example, you only plan on living in a home for 5 to 7 years, an ARM is a good option to consider. Other things that can affect the pricing of your individual loan are things like loan type, loan to value, loan size, credit rating, and property type. We spend a lot of time monitoring the mortgage bonds to anticipate price direction in the short term, which is what is most important to you. Once you have a contract with a closing deadline, we are able to lock your rate in at that point. The length of time needed to secure your rate can also impact the rate that you get. Shorter term locks are generally cheaper than longer term locks. If you only need 30 days to lock your rate through the closing date, you would get a cheaper price than if you needed 60 days to lock the rate through closing. Our goal is to help you get the best rate option available for the loan you choose, and we believe that a better understanding of how rates are derived will help you with that. In the next video, we'll be talking about the differences between an appraisal and an inspection.